Hello, good day. Tea with Travis. My tea is actually behind my desk here, but I had tea this morning. As you've all heard, the Fed had cut rates yesterday. Again, short-term rates, the Fed funds rate, and also the discount window of 0.5%. And so a lot of confusion has come in. Hopefully most of my clients are versed in this, but some of you that may be new to working with me don't realize the impact of when the Fed cuts short-term rates or the Fed funds rate. It doesn't directly relate to a cut in long-term mortgage-backed securities like a 30-year fix, and actually it works in the inverse effect, which is mortgage rates typically rise after a Fed cut. So there are two separate entities. The Fed funds rate, banks will follow in line and adjust the prime rate, which is not set by the government, it's set by the banks, but it typically follows in suit within 3% of the Fed funds rate. Fed funds rate was dropped to 1% yesterday, the lowest since June of 2001, and in turn making the prime rate at 4% even. And with that, things that are affected by the prime rate are things like your car loans, your credit cards, even home equity lines. And maybe 2 years ago, that would have directly affected credit card rates where you get the 0% offers until next September, or you see home equity lines down to 4%, where your home equity line, your second loan, is actually cheaper money than your first mortgage. But right now, with such a credit crunch, that money's not quite as available, so you may not see the 1% auto financing, you may not see the 1% offers on credit cards right now because of the credit crunch. But had there not been a credit crunch, the Fed's dropping the Fed funds rate to 1%, that's when you see those offers come out. Also, typically when the Fed's cut, that it weakens the dollar. But in the recent weeks, Europe has cut, the EU has cut their rates, Britain has cut their rates, Hong Kong cut theirs by 0.5% yesterday, Taiwan did as well by 1/4. So not only is our Fed funds rate or our short-term interest rates cut, globally they are as well. So our dollar actually popped up yesterday, when in recent history, when we cut rates, our dollar weakens, which is not the case. Oil's on a little bit of a rebound this morning. That's down $2. It had climbed yesterday some, but we're still at $65 a barrel, $100 less than it was back in July. The problem right now is mortgage rates are pretty high right now. They've bounced up. They've been a moving target for the last few weeks, but they're almost at the worst levels of 2008, and so not real good. Probably not a big sign of relief coming either. Yesterday with Ben Bernanke addressing the Fed fund meeting, he said that inflation is not really the issue right now. It's more the short-term problems of the recession. Our gross domestic product, the GDP numbers came out today, and it's the first time we've seen a decline in 17 years, and it's the largest drop-off in 28 years. And so the economy has definitely slowed down. It's a sure sign of recession. We've kind of assumed we've been in recession for the last few months, but these are the true numbers. It's two quarters in a row of the GDP being in a negative stance. So we've just got our first time at 0.03 of a loss that we are in that now. Also, consumer spending dropped by 3.1% last quarter, which is a huge number. And things like American Express has laid off 7,000 people here this week. That's 10% of their workforce. So when American Express is struggling, as much as we know how much money they make in late fees and credit card interest, to see them really getting an impact, it's truly a time that we are in a recession. Outside of that, not anything real positive to share. Again, the oil's staying low, so we're seeing that in the gas pumps. But outside of that, we're going to see some struggles for a while. So that's the update for today. I will get back with you tomorrow. Hopefully there will be some dust settling here. The Dow's up 162 points right now. Mortgage-backed securities are flat, but again, they pretty much got the damage done earlier in the week, Monday and Tuesday, anticipating this Fed cut. So again, rates are probably at the highest level. If they this year in 2008, if they drop below this other layer of support we have right now, we may see rates even get a little bit worse. But nothing really showing that that's going to be the case. So have a great Thursday, and we look forward to serving you. Just give us a call and be blessed.